Welcome to another Taking Stock episode for the week ending the 3rd of October 2025. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to your thing share market. Welcome, Jason. I can't believe another month has just ended.
Yeah, I know. It's almost jingle bells, Kien. So this year's gone by very, very quickly again.
Yeah, incredible year, especially for Star Stocks. But as always, the information we share today is of a generic nature and doesn't take into account your personal situation or needs. Shares are volatile, and any past performance figures aren't indicative of future performance. Well, Jace, it's been another resilient week for share markets. And in the United States, there was a federal government shutdown, and that began in October the 1st. But it did little to dampen sentiment with investors, expecting the disruption to be quite short lived. And we had technology and AI leaders such as NVIDIA and Apple. They helped keep momentum alive on the back of ongoing capital investment and optimism around Fed rate cuts. Still, though, you've got weaker jobs data in the upcoming October earnings season. That reminds investors not to be too complacent.
Yeah, that's right, Ken. Locally as well, the Reserve Bank has left rates on hold at 3.6%, and they've kept a pretty cautious tone in regards to future rate cuts, which has tempered a bit of the market's optimism coming into the end of the year. Despite this, the lockdowns have effectively seen the gold price deliver pretty strong results, and this was despite some of the weakness that we've seen or observed across the resource sector, which has been under a little bit of pressure after reports from China that they will be pausing some of the iron ore purchases from BHP and other miners that we have in Australia as well. So I guess on the whole, the gold theme has continued to drive a lot of our star stock performance because we do have an overweight position in gold. If we were to look at some of the star growth stocks over the past month, star stocks rose 1.7%, and this has significantly outperformed the All Ordinaries Accumulation Index, which fell by 0.5%. For the year to date, star stocks are up 23% versus the market return of only 11%.
Yeah, incredible numbers for star growth stocks, Jace. But meanwhile, star income stocks didn't fare too badly last month either, outperforming the ASX 200 accumulation index by around 30 basis points. And that was helped by its exposure to Evolution Mining, which rallied around 27%. And that also coupled with good performances from the REITs like BWP Trust and Waypoint and Dexus Industrial as well. But speaking about gold stocks, Jace, let's now turn our attention to a recent initiation, Alkane Resources, which has also been a strong performer. Now, the miner has undergone a major transformation. Until recently, it was a single gold mine in New South Wales, but in August, it merged with Mandalay Resources, and that added two more operating mines, Costerfield in Victoria and also Björkdal in Sweden.
Yeah, this was a pretty transformational change for Alkane, which effectively elevated the company into a mid-tier producer and also with international exposure as well. The company is targeting 160 to 175,000 ounces of gold in FY26, which is more than double FY25 production. So it also brings a pretty strong exposure to antimony, which is a pretty critical mineral that is used in electronics and also batteries as well.
Yeah, and that merger is why the numbers are so strong, especially the earnings growth numbers
Mm.
under Golden Rule 3. But with that growth story, though, comes with some challenges. Running three mines across two countries is more complex than one. And costs is the big issue here. Alkane expects all-in sustaining costs of around 2,750 an ounce. Now, that's around 28% higher than larger peers like Northern Star.
Yeah, the main drag to that, Kien, was the Swedish mine, where costs were unusually high this year. It was over $4,000 an ounce, and this was due to a lot of the heavy spending on development and also infrastructure costs as well. Now, if management can successfully integrate the Mandalay project and also bring the Swedish mine costs down after this investment phase, then we think the company can deliver a pretty respectable return on investor capital of around 57%, which is pretty solid for a mid-tier producer of this size.
Yeah, very strong numbers there, Jace. But let's now turn our attention towards another star stock, Bravura Solutions, the wealth management software provider that's regained some momentum. The company recently upgraded its financial year 26 revenue and underlying earnings guidance by around 4% and 20% respectively.
Yeah, the upgrade reflects three drivers. Firstly, a pretty strong British pound, as most of the revenue comes from the UK and also in Europe. Secondly, there was a pretty high project work from wealth clients across Europe and also the Middle East as well. And thirdly, we did observe a little bit of cost efficiencies, and this was after a major 2-year restructure program.
Yeah, they have undergone such a strong restructure, but this has triggered positive earnings revisions with analysts now forecasting return on equity near 46% in financial year 26, while revenue growth remains modest due to client losses expected this year. You've got stronger project activity, and that is filling the gap. Beyond financial year 26, though, management do expect steady mid-single digit growth from indexation, rising client volumes, and also new contracts.
I guess the key watch point here, Kien, is definitely execution. And this is especially given the stock is now trading at a premium to fair value. But with a stronger outlook and also a new CEO joining the board January 2026, the company looks better positioned to sustain its turnaround and potentially deliver a strong return to shareholders.
In Under the Microscope this week, we take a look at AIC Mines. The code is A1M. It's a small but rapidly scaling Australian copper producer that's transforming into a mid-tier player. Its flagship Eloise copper mine in Queensland has long been the backbone of the company, but now AIC is linking this mine underground to the nearby Jericho deposit, and that move is designed to lift copper output from around 13,000 tonnes a year to nearly 20,000 over the next 3 or 4 years. And this growth strategy positions AIC to benefit from the long-term demand for copper, driven by electrification and also renewable energy.
Yeah, this growth pathway seems pretty exciting, Cam, but it also comes with a bit of challenges as well. AIC remains a single hub operator, which means that production is concentrated at the Eloise and Jericho assets. Now, that concentration exposes the company to operational disruptions, such as weather-related events that have previously delayed such operations in the past. It's also a smaller cap company as well, at around $290 million market cap. And with lower daily traded in terms of liquidity, this could make a little bit of the volatility in terms of the share price gyrate around a little bit, dependent on market sentiment.
Yeah, definitely, Jason. In recent months as well, analysts have reduced their earnings expectations following their financial year 25 result. And this was due to a delay of Jericho's first ore to mid 2026. Also, there was a 55 million equity raise in June, which diluted its earnings per share, while near-term capex came in higher than initially expected as well. Financial year 26 is shaping up as a transition year with production and costs broadly flat, while the company invests to unlock into its next growth phase. And this is translating to a return on invested capital of around 10 to 11%.
Now, looking beyond FY26, the potential is rather significant. Once Jericho feeds ore into the expanded Eloise plant, which is due for commissioning in late 2026, production could theoretically rise by 50 to 80% with improving unit costs as well. Consensus is all positive on the stock, and they're all anticipating a return on invested capital to climb to around 17% by FY27. But what's worth noting is that the target is rather sensitive to copper pricing, which remains quite volatile, and this is something that investors need to bear in mind.
Yeah, quite strong numbers there, Jason. And on the positive side as well, when you're looking at AIC, they appear attractively valued relative to other copper stocks. Management is aligned with shareholders. CEO Aaron Colleran, who helped build Evolution Mining into a mid-tier success, and also Chairman Joseph El Rayhi, both hold meaningful personal stakes. Still, execution risk is front of mind. You've got to integrate that Jericho mine, controlling the costs at a time of labor and energy inflation, and also managing that capital-intensive growth plan with a modest cash buffer will be critical to its success. During the week, we had a few questions regarding insider selling. So the question of the week this week is, when a founder or director sells shares, How can you tell if it's a warning sign about the future prospects of the business?
Yeah, this is a question that we get quite often, Kien, because a lot of investors do really want to know some of the reasons behind the sale. And I guess that's the first point of call.
Mm.
Check the company announcement. Was it tied to any options vesting activities, which is where executives sell to cover tax obligations, or was it a direct reduction in ownership? Many sales are pretty routine, especially after options conversions.
Right, and you can see that under the corporate page in Stock Doctor. Next, look at the scale of the sale. If the director still holds a meaningful stake, that's usually a sign that they remain aligned with shareholders. A massive cutback that leaves them with little exposure can be more concerning. In addition, check the share price undergoing Rule 4. An elevated share price may mean that directors are using this as an opportunity to lock in some significant gains.
Another area to potentially review is the track record of such selling activity. So, for example, Breville CEO James sold his shares in September, but if you look back in towards history, he's also done the same in September 23 and also September 24 as well. And this consistency suggests some sort of routine post-vesting activity rather than any insider selling that could raise red flags.
Yeah, and most of the time, there is little information provided about the director selling activity. Hence, it's important to do your own due diligence, assess the business fundamentals, look at recent earnings revisions, for instance, and trading updates. In the case of Breville, the fundamentals appear intact, with earnings revisions positive and forecast growth metrics like ROE quite stable.
And another good point to potentially look at as well, Ken, is the broader insider and also institutional activity as well. And what this means is if multiple directors are selling heavily and the short interest is climbing, then both of these signals combined could be a pretty strong indicator for investors to be a little bit cautious. However, one-off sales, especially routine ones or tax-driven ones, are less of an issue.
And if you have any questions on any particular stock or share sales, feel free to contact our analyst team. But that's all we have time for today. Thanks again for joining us, Jace.
It's always a pleasure to be here, Kien. And as always, for any members out there, feel free to join us for Lincoln Live every Monday if you have any questions from today's episode.
And before we wrap up as well, just a quick reminder, if you have friends or family who could benefit from Stock Doctor, feel free to share our link to them. Our growth comes from our members like you, and we truly appreciate your ongoing support. Until next time, take care and have a happy, healthy, and prosperous week ahead.